Welcome back to Thimbleberry U. I'm John Jack Gay, joined as always by Amy Wallace from Thimbleberry Financial. Amy, pleasure as always to be with you.
Jack, it's great to talk to you.
So you may have heard the term dollar cost averaging or dollar cost average investing as opposed to lump sum investing. We're going to kind of break down these two different strategies today. Let's start with the basics. Explain what is lump sum investing versus dollar cost averaging.
Lump sum investing is the idea or the practice, really, of taking a larger amount of money and putting it all into an investment at one time. So, for example, if you were to receive a big bonus, and let's say it's $100,000 after taxes.
Nice even number.
Right. You take it and say, okay, tomorrow this is all getting invested. So it happens all at once. If we contrast that with dollar cost averaging, and we use this $100,000 that was received in a bonus, maybe you invest $10,000 a month for 10 months to get that money invested. So with dollar cost averaging, we're spreading the investment out over a period of time. Now, I imagine the next question is, why would you do this? Dollar cost averaging essentially allows you to buy more shares when prices are low, and then you buy fewer shares when the prices are high, and so that overall it balances out.
Okay, so with the dollar cost averaging, you're investing the same amount every month, so that same dollar amount gets you more shares when it's low, gets you less shares when it's high. Got it.
Yes. Essentially, you're diversifying your time frames since you don't know if when you put money in is going to be high or low.
Okay, so my next question, you can probably anticipate, why would someone choose lump sum or dollar cost averaging?
There's different benefits to each one, obviously. So benefits of lump sum investing are a higher potential return. So Vanguard has done some research on this, as has some other companies. And the research shows that lump sum investing outperforms dollar cost averaging about 68% of the time.
So 2/3.
Over 1-year periods and 10-year periods. And the idea is that it gets your money working in the market immediately. Okay, it's also simple. It's a straightforward approach. You do it once, you forget about it. Now, there's benefits to dollar cost averaging also. Biggest one is risk mitigation.
Yeah.
So by spreading out when you invest, you reduce the risk of investing a large amount just before a market downturn.
Okay.
So in the example I used earlier, if I put in $100,000 tomorrow and the next day the market drops, I may kick myself because my $100,000 immediately became $70,000.
Right.
If whatever investments went down 30%. So that's why dollar cost averaging is helpful. It mitigates that risk. The other thing is behavioral comfort. And it ties in with the example I just gave. It mitigates the fear of making a big investment decision, which may be uncomfortable. Okay. And all of that can lead to better decision making in the future. So, we sometimes talk about the psychology. If I invest $100,000 tomorrow and the next day it becomes $70,000, do I understand that I invested this for the long term and it's a blip? It will come back. It should come back, assuming it's market conditions versus just picking a very poor investment. Or am I going to look at that and say, oh no, and the story I tell myself is I lost $30,000. I should not do this. And so in the future, when I think about investing, I'm always going to repeat that I made that mistake and not want to invest.
So that is the real risk with lump sum investing. You mentioned the Vanguard study that shows that 2/3 of the time lump sum investing does come out ahead. But it sounds like you're getting to the answer to my next question, which is why would someone still choose dollar cost averaging? And a lot of that is the psychology, I imagine.
It absolutely is the psychology. Those stories we tell ourselves, quoting Brené Brown on those stories, they're powerful. We attach to them. It's a form of anchoring bias, right? And confirmation bias. I made this mistake, therefore it's going to happen again. I'm going to do these things. So that's daunting and stressful. And so if we're somebody who we know is going to do that or has an inclination to think that way or remember it that way, we would want to choose dollar cost averaging so that we can succeed in the future.
So full disclosure, my wife and I actually do both. My wife is a W-2 employee, so her money goes into her 401k and her taxes every month, and we do our finances every month, and we give some to our financial advisor to invest every single month. So similar to dollar cost averaging. But for me, as a solopreneur, self-employed LLC, I put away money for taxes and investments, throughout the year. And then at the end of the year, once we've worked with our CPA and our financial advisor in concert, and we see, okay, what's left that I can dump into my SEP as a solopreneur. So she's doing the dollar cost averaging and I'm doing lump sum investing. So we kind of have the best of both worlds.
Absolutely. And I think that can be a great way to handle that. Many of our clients, whether in tech or in healthcare, are dollar cost averaging as part of their investment strategy. But then many times, because we know they're going to have tax bills that we want to leave extra cushion for and that we can't predict perfectly over, in 12 months in advance, we've left an extra cushion there, or stock's going to pay out. And so we may lump sum invest those dollars, all depending on personality. Some of them, we still dollar cost average those extras.
Fair enough. All right. So Amy, how do market conditions affect the choice between these strategies?
That's a really great question, Jag. So in a bull market, when the market's doing well, it's going up, lump sum usually performs better because your money's fully invested and benefiting from market growth. Okay. So a lot of times when it's going up, that's when people say, sure, I want to just put it in now and take advantage of this upturn. When it's going down or in periods of volatility, meaning where it's bouncing, that's where dollar cost averaging may be advantageous because it allows you to buy at lower prices if it is going down.
Got it.
Now, I'll say that, and I think back, my perfect example of this is March 2020. COVID had just hit. The market dropped quite a bit for about a month. We had a number of clients who actually are on the more moderate end rather than aggressive, who had extra money, who were like, wow, this was a quick, fast decline. We have cash on the sidelines that we have been dollar cost averaging. We're happy knowing we're getting in at a 30% decline, and we're going to stop our dollar cost averaging and switch all of that to lump sum.
Interesting.
Because they said, look, we can tell ourselves, the story we can tell ourselves is we already just gained 30%.
Yeah.
And so we're happy even if it drops further now.
Makes sense.
And it simplifies our lives going forward.
So you alluded to some of this earlier, Amy. What about the historical performances of these strategies?
So I mentioned Vanguard did this research. They looked at markets in the US, the UK, and Australia. And 66 or 67%, just to full and fair disclosure, there's a range of 1% for each 10-year period. So basically each decade, or I believe they broke it down for all 10-year periods. So it wasn't just decades that they looked at. 66 or 67% of the time, if you lump sum invested, you ended up with more money 10 years later.
Okay.
Well, in a 10-year period, the market tends to be up most of that time. Okay. Which is why that would happen. Now, where that may not happen is it was an extra volatile 10 years, or there was a big decline right before the 10-year period was up that maybe caused the end value to be lower than what was put in.
Skew the total number at the end. Got it. Okay.
Exactly. And the interesting thing to note about this is that's a 10-year period. That's still not a long-term investment time frame. And so the further you go out from 10 years, the greater that success rate of having more money, having more than you put in, actually increases.
Are there a specific type of investors that would prefer either dollar cost averaging or lump sum investing, one over the other?
Absolutely. Risk-averse investors tend to like the dollar cost averaging more.
Yep.
I'd also say people who like process and consistency. The other group that this is really good for is, let's say somebody has been sitting on a lot more cash than they need and have been sitting on it for quite some time.
Okay.
And maybe they're going to right-size that cash reserve and get money invested. That's a shock to the system when you open the bank account and it's, half or less than half of what it's been for several years. That's rattling to people. no matter what your risk tolerance is. You get used to opening it knowing you have that security. So a slow adjustment can be very beneficial in that case. For those that are more comfortable with risk, that are more focused on maximizing returns, and can stomach that downturn, they're probably more attuned to the lump sum investing with extra bits of money. Now, you mentioned your wife investing in her 401k, dollar cost averaging. Those people still are likely to be doing some dollar cost averaging and probably should be.
Sure. Okay, so what are some practical tips for someone deciding between these two strategies?
Assess your risk tolerance. Now, that's self-assessment because you may be able to quickly come to a decision based on some of the things we've already talked about. But maybe talk to people who know you.
Yes.
A partner, a spouse, a best friend. Really, if you're on the fence, they may be able to sway you to the kinds of stories you actually tell yourself. Because I think too often we are not aware of the stories we tell ourselves. Consider your situation and your goals, right? Do you have a big emergency fund? Does your investment decisions and your time frame for when you're going to need the money that you're putting in, does that sway if you want to make a lump sum investment or dollar cost average? Avoid market timing. Now, I used the example of March 2020 earlier. Some people could say that's market timing. And in a way, in a sense it is. It's also opportunity. Market dropped 30%. Look, this is a reaction to this COVID announcement. Whether or not this downturn lasts a year, I'm okay with it because I'm not going to need the money. And I just gained 30% rather than investing this when it's high.
Buy low, sell high.
Exactly. So there's logic that's applied to that, but just saying, I'm going to do this now and put this $100,000 in because so-and-so got elected, that would be much more of market timing.
Got it. And an emotional decision, as we talked about in our previous episode as well.
Absolutely. And then getting advice, right? I don't mean as a financial advisor to tout the use a financial advisor, but even though I said talk to, partner, spouse, best friend, somebody who does this day in and day out will be able to help you recognize what might fit you best.
That is key right there. What is our final takeaway for listeners when it comes to lump sum investing versus dollar cost averaging?
There's no right or wrong.
Okay.
Number one, I think the only wrong decision is a decision that keeps you from investing in the future. So your personal comfort matters.
Yeah.
It absolutely matters. So while lump sum investing tends to outperform, that shouldn't be the reason to do it if you're going to be uncomfortable. And then maintain a long-term focus. Don't invest if it's short-term. Know that it's long-term and how those numbers typically work out in making your decision.
Great advice, as always, Amy. And if you want to talk to Amy and her team at Thimbleberry Financial about the behavioral finance piece of it, the actual numbers behind all of this, I know she and her team are always available. What are the best ways to find you?
They can reach us at 503-610-6510 or online at thimbleberryfinancial.com.
Great stuff. As always, Amy, we'll talk again in a couple weeks.
That sounds great, Jag. Look forward to it.
Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Thimbleberry Financial are not affiliated. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Thimbleberry Financial are not affiliated.